All right, so this is a 10-minute lesson in life insurance. And more people spend money on life insurance and don't really know how it works. So let's look at life insurance here. So if someone wants a $500,000 death benefit, we know that there's a minimum premium that you can pay for that same $500,000 life insurance policy. But there's also a maximum amount that you can pay for that same $500,000 life insurance policy. Now, why is there a difference? Well, who sets the minimum? Well, it's set by the actuaries of the insurance company. They look at your medical history, they give you a physical exam, they study your genealogy, and they come up with a number. All right? Now, who do you think picks the maximum amount that you can pay for the same death benefit? Well, it's the government. Now, why would the government care how much money you spend on life insurance? Well, let's look at this. So what we know is that there's an infinite product design anywhere from the minimum to the maximum. So what we know is that if you're only looking at the minimum, that's usually term insurance. The reason the government is interested in how much money you put in life insurance is because they want you to put money into qualified plans, the places where they want you to have the money so that it gets taxed. That's IRAs, 401k plans, SEP plans, 403b plans, things like that. There are quite a few different types of of qualified plans. And one of the things that we know about qualified plans is that they do two things. They defer the tax that you pay, but they also defer the tax calculation. We call it postponing the tax calculation. So what we want to do is look at getting your life insurance policy designed right up to the maximum amount. If we design it to what we call the modified endowment contract, which is the rule that the government comes up with, what we know is that it will be the most efficient policy in terms of rate of return. And this will be a tax-free rate of return. So if you exceed that by a penny, then the whole thing becomes taxable. So that's why it's important for the design to be proper. We also know that if you're paying, say, $1,000, which is the minimum premium, and the maximum premium is $10,000 for that same $500,000 policy, why would anybody pay more than they need? What we do know is that the minimum premium has to do with term insurance, and the only way you win with term insurance is you've got to die, because all you get is a death benefit. And the best deal for term insurance is the first day that you buy it. And if you die that day, you've gotten the best deal. Okay, obviously no one wants to die. So what we want is, when we look at investments, is we want something that's tax deferred. We want tax deferred growth. Everyone wants that. We also want a tax-free distribution. That's really important, because we don't know what tax bracket we're going to be in later on when we're ready to retire or whatever. Because a lot of people, when they retire, are the perfect taxpayer. All their deductions are gone, their mortgage is paid off, the kids are out of the house, and the government's forcing you to take more and more money out of your retirement plan, so you get in a higher and higher tax bracket. So tax-free distribution would be very helpful. Also, you want a competitive rate of return, right? You want high contributions. You want to be able to put in the maximum amount of money that you can afford to put in. You also want to have additional benefits, things like waiver of premium, where if you became disabled, those kinds of things. Also, collateral opportunity. You want to be able to go to a bank and be able to use this asset as collateral to borrow money. You also want a safe harbor. When I say safe harbor, I mean if somebody tries to sue you or wants to come after your money, you want this money to be protected. You also want a no-loss provision. You want to be in a position where you can't go down. It only can go up. And you want a guaranteed loan option. What that means is that you can go to the financial institution that you have this product with and be able to borrow money from the financial institution, again, using your policy as collateral. And you want unstructured loan payments, which is really important, because think about this. Let's say you wanted to borrow money from your life insurance policy, and you wanted to use that to, say, buy a piece of real estate, but the real estate is vacant. You have to fix it up in order to get it going. You don't want to be paying money right away. If you borrow from a bank, they're going to expect you the next month to start paying money. Unstructured loan payments allows you to maybe defer paying it, not even pay it back for a long time, or never pay it back. That would be very helpful. Also, you want liquidity. You want to be able to use it and control it. One of the problems with retirement plans is that you put money away in those retirement plans, you can't get to it until you're 59 and a half. And even then, you'd have a tax consequence. Also, it would be great if we could get a deductible contribution. That would be also important, right? So what we do is we look at what does life insurance provide for us? Well, it certainly gives us a death benefit for sure, right? But it also has living benefits. And this may be the most valuable part of life insurance. And what are those living benefits? Well, it has tax-deferred growth, has tax-free distribution when you take the money out, has a competitive rate of return. You can put high contributions in it, has additional benefits like waiver of premium and things like that. It has collateral opportunities. There's a safe harbor. If somebody tries to sue you, they can't get to it. Most states are protected by statute. There's no loss provision, so you don't have to worry about if the stock market goes down that you're going to lose money. It has a guaranteed loan option so that you can go back to the insurance company and they will loan you up to 90% of the cash value. No questions asked. Usually give you a check within 3 days. And they will give you unstructured loan payments so you don't have to pay back a set amount like a bank would require. It also is liquidity, so that means that you can take a lump sum out and use it for whatever you want and be in control. The only thing it doesn't have is deductible contributions. And quite honestly, we're happy it doesn't because we want the tax-free status of a life insurance policy in terms of its death benefit and be able to take money from the policy without paying any tax. So that's a lesson on life insurance. This is something that most people are unaware of. They don't understand how to use it, and it can be a great way for you to have a private reserve, be kind of your own bank as such, and be able to build up liquidity while having also a death benefit to protect your family. All right, so let's take a look at what some of the uses of life insurance can be. And the first thing I want to share with you, if I could, is a supplemental retirement plan. So here's an opportunity for you as an individual, whether you're a physician or whether you're a business owner, or if you just work for someone, you can set up a supplemental retirement plan. And it doesn't matter if you're in a business, you have lots of employees, you can exclude them. This is just for you. And so you can take some of your income, whatever surplus that you might have and that you could afford, and you could put it into contributions towards a supplemental retirement plan using a very efficient life insurance contract to fund that. And the beauty of this is that it can be a single member. It's an after-tax contribution with tax-free income at the end. So again, the whole idea is that the buildup of cash in a life insurance contract is deferred. It's tax deferred. And if you set it up and take the money out properly and never surrender the contract, it'll be tax-free. You'll never pay income tax on it. The plan is asset protected in most states. The contributions are not age-based in that it doesn't matter if you have partners or whatever in terms of restricting how much or how little you can put into the plan. It really is a factor of your income, your surplus, and so on, and your age. No required minimum distributions when you turn 70 and a half. So that's a beautiful thing. So you can kind of let it cook a little bit longer if you want to. It can be self-funded in the event of disability if you're young enough to be able to do that or want to do that. It usually has a pre- and post-retirement death benefit. So in case you don't make it to retirement, the family will still get the benefit. Okay? So what's interesting about this is the banks figured this out about 20 years ago, and they have more money, actually it's about $161 billion, in bank-owned life insurance set up just like this for their senior executives. In fact, they have more money in cash-rich life insurance policies than they have in the real estate holdings that they own. And you know banks have a significant amount of real estate holdings. So here's the pros and the cons. So clearly it's an income tax-free death benefit paid in cash to beneficiaries. It's tax-advantaged dividends. So what's interesting about this is that the dividends that come out, initially they're considered return of premium, so therefore there are no tax ramifications. And as long as it's set up properly within the life insurance contract, there's a tax deferral on those dividends as they come out. There's also a consistency. The Tiffany insurance companies have been around since 1860. That's 10 years before the Civil War. And they've never missed paying a dividend. And so that gives most of us comfort to know that companies that have been around as long as that and are substantial enough and have been consistent at paying those dividends. So it's very comforting, and most people feel very secure when they have their money with one of these major insurance companies. As far as estate planning and wealth transfer flexibility, clearly life insurance is one of the most flexible assets to be able to transfer wealth on the other side of the tax wall for the benefit of family. And I'll talk later in a video and show you a little bit more about how that works. Also, it's a plan that's personal. Employees don't need to be included. And so many people, as long as you don't surrender the policy for cash value, will grow tax deferred and will come out tax free in retirement. And by the way, you also have access to this by using the cash value to fund other needs like college tuition, if need be. You put money into a 401k plan or an IRA or something like that. Very difficult to get the money out without triggering any substantial tax or penalty. That's not true for a life insurance contract set up properly. So also, what are the cons? Well, clearly it requires free cash flow. If you don't have proper cash flow, then you're going to have to, you're not going to be able to do it. It's also not designed for a short-term strategy. If you commit to doing this, you want to do this for a long period of time. If you stop too soon, that you're not going to get the benefits. Also, the premiums need to be paid every year, and so that there's a commitment there. All right, so look, this is just an idea how to use life insurance. There are many, many other ways in which you can use life insurance. In the next video, we're going to talk about some of the obstacles that are going to be in the way of you having an abundant retirement. So stay tuned for the next video.